Well, welcome everybody. Like Morgan said, great to see everybody from a lot of different parts of the world. And today we're going to talk about a very interesting way of trading the markets. I call it the intelligent breakout strategy. So let's go ahead and dive right in. Now, my background, like Morgan said, is basically from the hedge space for about the last 20 years or so. And my role was focusing on developing financial models or quantitative models, if you will, and indicators for hedge funds. So that was a lot of fun. I have really enjoyed that, and I've been doing that since I was a mechanical engineer in college. So this is a lot of fun for me, and I'm probably most noted for developing the value charts model, and that's the first objective value quote-unquote model for the markets. It's designed to be like a super Kelly Blue Book for the markets to help traders understand the objective valuation for any market and time frame combination. So okay, somebody's asking me to speak up a little bit. I'll try to do that. Okay. All right, so let's go ahead and get started here. First, let's talk about a disclaimer. Trading or investing carries a high level of risk. It is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. The bottom line is, do not trade with money that you cannot afford to lose. Trading involves exposing your money to the chance of creating money, but also the chance of losing money as well. And I'd hate to see you lose money that you can't afford to lose. Now, the second part of this equation is reviewing CFTC Rule 4.41, which states that hypothetical or simulated performance results have certain limitations. So past performance is not necessarily indicative of future results. Now, Gary, you're asking, Mark, does the breakout look like Darvas box? No, that's actually a little bit different than that, and I'll show you exactly how that differs. Now, when we talk about the intelligent breakout strategy, we're talking about focusing on three things. Okay, we want a powerful tool to manage trades. And really what we're looking for is the help from rule-based trading to show us where we can enter trades and where we can exit trades. That's one of the aspects of trading that I find that most traders struggle with. And that's really what this is designed to help out with. So number one, again, here is a powerful tool to manage trades. Number two is strategic application of a trading strategy. So we're not talking about leaving a strategy on 24/7 or 24/5. We're talking about applying the strategy strategically when we think we have a higher probability setup. And then last but not least, we're talking about parameter skewing to increase the odds for success. And I'm going to show you with an example here exactly what that means. But this is a little bit of a different way to approach trading, but I think a powerful one. Now, what do people do well? What do computers do well? If you think about organizing trading in three primary components, if you will, we'll look at outlooks as developing an opinion, more or less, on what a market's liable to do, either long-term or short-term. Basically, when I think about outlooks, I'm thinking longer-term. And then within the context of an outlook, we're looking for setups. That's higher probability entry points in the markets. And those could involve things like candlestick patterns, geometric chart patterns, indicator values, and things like that, or Confluence using indicator strategies. And then last but not least, we're talking about signals. Where to actually enter into a trade, where to place a stop or where to get out, and then where to exit the trade. So we're talking about all of these things together. And what I've found over time is that outlooks, people can do a fairly decent job with outlooks if you spend the time to learn the skill set. Outlooks typically are not a highly emotional part of trading. Setups are the same way. I found that traders can do a fairly decent job with setups as well, in terms of studying the different patterns, if you will, using candlestick patterns as one example, or using value charts and momentum patterns or value bars patterns, to name a few. Those can be done by traders fairly effectively. Again, you have to invest the time to develop the skill, but typically when we talk about the outlooks and setups aspect of trading, we're talking about things that are not highly emotional. So we're not really dominated by greed and fear so much with those two aspects of analyzing trades. Where we are challenged as humans is in the actual signals. So dealing with fear, dealing with greed, when we talk about actual trade entries or trade exits or where to put stop losses. So what I have found and what this strategy involves today with the intelligent breakout, it's really utilizing the best of both worlds. So we're looking at relying on the trader or ourselves to formulate the outlooks, or relying on ourselves or the traders to formulate setups or identify setups, and then we're going to leverage computers to identify entries, exits, and stop placement. So that's really combining the best of all worlds there. And when I say computers, I'm really talking about rule-based trading. So it takes the discretion out of it. I find that it's a lot more effective when you do it that way. So let me pose a question to you here. This is a basic example of a strategy, and this was just thrown up there and had a brute force optimization done, not the entire one, even just optimized it a bit and took the best solution after a couple runs. And the question is, would you trade this strategy? We can see over here on the left-hand side, we have a short position that was profitable, and then we get chopped up a little bit here. And this is really almost an unfair question because we don't have enough data to analyze this, but let's go ahead and throw up the analysis here and determine if this is something we'd be interested in trading. Now, let's look at the equity curve. Equity curve, as you can all see, this is not attractive whatsoever. I don't think anybody would be super excited about trading this equity curve. It's not terrible, but it's certainly not great either. So we're looking at a crude oil strategy with profits at the end of, call it about 70 trades of right around $4,500. And we can see that we had some fairly sizable drawdowns along the way. Peak drawdown may have been right around, let's say, $3,000 from peak to valley or so. So this is not something that's very exciting, but let me show you the numbers that we watch for, in my opinion, as traders. So if you pull up a performance report, this is just an example one inside of TradeStation for this exact system after we ran the optimization. The numbers that I would say as traders should really be paying attention to mostly are a combination between percent profitable and ratio of average win to average loss. All right, there's a lot of other numbers out here and that we can watch for, and some of them can be useful as well, but I would say, you know, in a large part that, especially coming from the hedge fund space, that these two numbers had probably more to do with ultimate success than anything else. So let's take a closer look at that. I'm going to go ahead and throw up an Excel example here using these calculations. Now, let me just throw this up here. Excuse me, let me get my Excel. There we go. Okay. Make sure that everybody can see this. I apologize, it may take a second here. Can everybody see the Excel spreadsheet okay that I have up there? Hopefully the answer is yes. Okay, good. All right, excellent. So here's what I've created. This is basically a spreadsheet where I've created a randomizer using the statistics from our test. So from the brute force optimization that we just looked at, our actual percent profitable on the system I just showed you was 34.29%, and the ratio of average win to average loss was 2.7. Okay, so what I did was I created a spreadsheet here that would run this through about 100 trades using these statistics to see what kind of equity curves we could expect over a number of different iterations, if you will, a number of different trials. So every time I press save on the Excel, we're going to see a slightly different equity curve. So we see the initial one here, and really it's not terribly bad. It's profitable, but it's not great either from a reward to risk standpoint. So I'm going to go ahead and rerun the numbers. Certainly this next one looks fairly attractive, and that's something that we could get somewhat excited about. I'm going to run it again here. Every time I press save, it just continues to crunch all the numbers here in my cells. So again, 100 trades using 34.29% probability of having a winning trade, and if that winning trade does occur, that winning trade ends up being 2.7 times the losing trade on average. All right, so if we're averaging or risking $1,000 in this example, then we would expect our winning trade to come in right around $2,700. Okay, now here's the problem with this. All right, now so we can see that I just saved this. In this example, we actually came out with 42% winning trade because each individual trade has a 34.29% chance, but as we save it throughout 100 trades, that can vary. It can either come in above or below the 34.29%. We're getting a lot of ones coming in above here as we save these out. Not many coming in below, interesting enough. But let's take a look at the reality of this situation. So I'm going to go to the next tab here. The reality is that 34.29% and 2-to-1 win-loss is the best scenario because I just optimized the strategy, and that's really showing me a peak performance, if you will, through history. Now, my experience has been that you usually want to reduce your percent profitable numbers or the numbers in general down to make them more realistic. So in most cases, we're not looking to actually achieve the numbers that we test out at. So if it's 34.29, let's drop our percent profitable down to 25%, and we can now see when we do that, making these more real-world numbers, our equity curve goes from a winning scenario down to a losing scenario very, very quickly. All right, let me just save this again to refresh my numbers. Again, running this on a couple scenarios here. The reality is the strategy, even though my optimizer told me that I had, a profitable strategy, that is using the benefit of hindsight. So my computer can go and curve fit, if you will, or find a winning parameter set to apply to history. So 25% profitable and a ratio of average win to average loss around 2 generates a losing scenario or a losing expectation here through a number of different tests. So I'm going to keep on pressing the save button to refresh my numbers. And in general, instead of having an average of a winning scenario, I'm expecting now to have an average of a losing scenario using realistic numbers. Now, here's the point I'm trying to make here. Let's go over to the 40% win-loss. So that's not even winning half the time or more. It's really only winning 4 out of 10 times. But taking advantage of that win-loss ratio, we can see that our numbers start to become a lot better here. And the point I'm trying to make here with the intelligent breakout strategy is that we don't want to trade all the time. Okay, you want to trade when the odds are in your favor. And if we can start to learn how to apply strategies, even leverage rule-based strategies when we feel like the outlook and the setups are in our favor, then there's a pretty good chance we can achieve these type of numbers. And so if we can achieve 40% profitability, that means winning trades are only 4 out of 10 times, and a 2-1 reward to risk ratio, it's certainly not unreasonable whatsoever. We used to have some strategies with the hedge fund that would actually have as high as 6.5% reward to risk ratio. So it's very possible to have a 2.0 average win to average loss ratio. So, and again, percent profitable here is 40, I should say. Now I'm going to go ahead and reset this, and you can see that even though I keep on resetting these numbers, the average expectation continues to be fairly profitable. All right, some of the equity curves look better than others, but the average equity curve is profitable, and some of them actually look fairly good. Now, let's say we're able to actually increase our numbers even more, so we win just half our trades. And again, we're able to hold in a win-loss ratio of our average winning to losing trade ratio of right around 2. We can see that our equity curve now looks extremely attractive. Okay, so the point I'm making here is that when you're trading, if we can work on these two numbers, the percent profitable and also the ratio of the average win to average losing trade, we can achieve some very, very good results using probability in our favor here over time. You can see the equity curve again, as I continue to refresh here, is very, very strong. Okay? So again, as I just refresh a few times, very, very strong. Now, again, just to show you as an example, we certainly don't expect to have 6 out of 10 winners, but if you even increase or improve the situation further, just looking at how the probabilities affect the scenario, you all of a sudden have an absolutely incredible looking equity curve here. Okay, I mean, anybody in the world would probably put all their money in any type of strategy like this. So my challenge is to focus on trying to find scenarios where you can increase these two numbers. These are the two numbers in my mind that you want to focus on really more than anything else. So let's go ahead in our example here and talk about the history about. My first introduction to Breakout really had to do with the Donchian breakouts that the turtle traders used in the early 80s. Now we do have a question. Gary's asking, what about commission slippage? Gary, those can be very relevant numbers. It really depends on how frequently your strategy trades. I recommend certainly taking a look at those and developing realistic commission and slippage numbers for yourself, but you absolutely do want to take a look at those, because if you have a high frequency trading strategy and you don't look at those, you can actually turn a winning strategy to a losing strategy very quickly when you introduce the commission and slippage numbers. So I do recommend doing that, but at the same time, there are times when you optimize your trading strategy when you do not want to include that. So there's situations where in both cases where you want to look at the two different with or without those commission and slippage numbers. So going back to the history of Breakout, Richard Donchian was introducing a breakout strategy that some traders used, where you had maybe in one example, a 4-week breakout to the upside. You could be weekly price bars, and then your exit would be half that. So oftentimes it would be 2-week breakout on the downside. And that used to be fairly effective over time. Now, breakout strategy. What is a breakout strategy? It's a price movement through an identified level of support or resistance, which is usually followed by heavy volume. I should put even hopefully followed by heavy volume and increased volatility in the direction of the breakout. So that's the hope there. Traders will buy the underlying asset when the price breaks above a level of resistance, or your buy level, and will sell, either reverse or exit your position when it breaks below the support. So let me go ahead and give you an example of what that might look like. If you use a traditional breakout strategy, you'll see that I have a green line and a red line here. So if I have a 3-bar breakout, you'll see that going back for 3 bars, my green line is going to be at the highest high level, and my red line is going to be at the lowest low level. So if this is a stop and reverse strategy, when I break below the red line, I'm looking to go short or sell that market. And what I typically like to do is not only sell at those levels, but one tick beyond those levels to make sure that the market actually is exceeding those low levels. Now, here's my experience. We used to trade these in our hedge fund back in the mid-90s or late 90s, the breakout strategies, but I have found over time that the markets have become a lot more volatile, a lot more choppy, and the breakout strategy in and of itself left in the markets all the time really is not going to do very well. So I found that it needs help. There's a way we can tweak this, though, to make it work in our favor and to make it much more powerful. So again, for those of you who are not familiar with breakout, this is a 3-bar breakout example. And you can see, again, going back for 3 bars, taking the highest high and lowest low of the last 3 bars. Let me show you a 5-bar example. Again, not including the current bar that's in process. I'm going to count 5 bars back and find the highest high. So here, bar number 4 has the highest high level. We'll populate or plot our green level up there. And then going back, counting back for 5 bars, we can see that bar number 2 bars back has the lowest low. So that's going to be our breakout or an exit point on the downside. Okay, and the current bar that's currently trading or in process is not considered as we formulate the highest high and the lowest low levels. Now this is a 10-bar example. This will be the last one I show you, but just to give you another idea, count 10 bars back. You can see bar number 6 has the highest high, bar number 3 has the lowest low. So it's fairly simple to use. You can do it even by hand. A lot of traders used to do it by hand, but it's very easy to do, even easier to do on a computer. All right, so that's what that looks like. Now, in breakout strategy pros, or benefits. The first benefit is it ensures participation in a major price move, and that's really a huge benefit. So if you have a very strong opinion that a market's going to go higher, and then you are able to find a strategic entry point or an attractive setup level, then a breakout strategy is a great way to go in many respects. And the reason why is because it can be very effective at getting you in and ensuring that you participate in the move if it does indeed happen like you expect it to. So that's one of the biggest benefits, in my opinion, of trading a breakout strategy. Next one is it's an easy strategy to understand. We saw by the previous slides, if a price or the current price level goes above the highest high of so many bars back, we're looking to buy. Again, I recommend adding a tick on to that level just to make sure you're actually breaking through and not just equaling the previous highs or lows. It will not hold positions against the trends. So let's say you have a breakout strategy, you have a great outlook, and you have a great setup, you believe, and all of a sudden you're looking to buy and you're using breakout methodology. Let's say the market just completely goes against you and you're dead wrong. Well, the nice thing about the breakout is it's going to keep you out of the market. So if the market goes right against you and it falls off very sharply, the breakout strategy is a nice mechanism, if you will, to enter buy and sell signals, because it's going to actually keep you from entering the market. Now, what are the weaknesses of a breakout strategy? A huge one is really vulnerable to false breakouts, and this is a big one. And that's why if you apply the breakout strategy 24/5, you're going to find that most of the time, in fact, I've never seen an exception to this, your percentage profitable trades is going to be well below 50%, maybe even very much in the 30s or the 20s. So a lot of false signals with the breakout strategy. Our average reward to risk ratio, again, if you leave it on all the time, and it does not enter the market strategically. Now, I say that because by design, you're buying short-term overvalued when you break above the old highs, or selling short-term undervalued. So from a strategic standpoint, it oftentimes is buying or selling at a point where you most often do experience a correction against your position before you start to achieve profitability, and that's on the winning trades. Okay, but there are certain rare cases where the market just takes off in your direction and you catch the wave just right, and there's not much of a unrealized loss period in the markets. Okay, so these are the cons. Now, we can take these negatives here and dramatically marginalize them or reduce them with something I'm going to show you. Again, this is called the intelligent breakout strategy. So James is asking a good question. What is the advantage of Donchian breakout? Now, I'm not even suggesting we use Donchian breakout here. I'm going to show you a very different way of applying the breakout strategy that's going to be designed to tilt the odds in our favor. So here's the breakout strategy notes in general. Breakout strategy is not an all-weather trading solution, in my opinion. You do not want to leave this on 24/5. It's not going to be the best way to approach trading the markets if you want an all-weather solution. Now, the other thing is remember, you can get chopped to death if it's not calibrated correctly, and this is primarily in a situation where you leave it on all the time. But even when you leave it on strategically, you need to understand the basics behind parameter selection, and I'm going to show you some tips on how to do that. So, sorry, let me go ahead and turn my office phone off here. All right, so generally buys overbought and sells oversold by design. Okay, we can live with that. Does not enter markets strategically. All right, no problem there. We're going to fix that with something I'm going to show you here in a second. Completely ineffective in some environments. Okay, and then last but not least, in the right environment, it can be highly effective. So if you were to look at this list right here, I can tell you that most serious active traders, they gloss over the breakout strategy because in general, if you apply it in the traditional sense, it's not going to be something that really stands out among other strategies. But with what I'm going to show you today, there is a way you can take this and turn it into something that's pretty special. And an analogy I can give you on that is if you ever follow the kids who race their cars and they have street races, some of the fastest cars out there are some of the most unlikely cars that you'd find, that we would probably overlook ourselves. Like some kids are taking Honda Civics, believe it or not, and souping those things up to like 700 or 800 horsepower, and they end up just destroying Corvettes, you know, in the quarter mile race or whatever it is. So there are ways to take plain vanilla or plain Jane approaches and turn them into something special by making tweaks and modifications. Okay, let's see. Hasn't HF trades built breakout strategy into their algos? I'm not sure, frequency traders. Yeah, Rodney, this is not so much, maybe the high frequency traders have counted on people using these, but with what I'm going to show you today, it's going to counteract that. So it's not going to, high frequency traders in general, what I'm going to show you today are not going to be an issue. Okay, now what we want to do here is we want to now transform this traditional way of trading into something that's special. We're going to transform it into what I call the intelligent breakout strategy. Now, first of all, what we want to do is find strategic trade setups on a longer time frame. So if, let's say I'm looking at a weekly chart and I have a very strong setup on a weekly chart, what I'm going to do with the intelligent breakout is drill down to a shorter term time frame. So I want to apply a breakout strategy to a shorter term time frame by drilling down. So if my setup's on a weekly, I am looking to apply the intelligent breakout strategy to daily, or 240 minute, 60 minute, 30 minute. So I'm drilling down to a shorter term time frame. I'm going to modify my parameters for a directional bias, and this is where the power comes in. We're taking that Honda Civic and turning it into a 700 horsepower car that can beat the Corvettes by doing these things. Okay, once profitable, we can have the option of lengthening our parameters or modifying our control of our position if we want to, and essentially be in a position where we have a break-even situation. Now, again, understand that anytime we talk about the markets, there's really no guarantee that any of us are going to be filled at the level of our stops, but really most of the times we can count on the markets getting us out where we position stops. So that becomes extremely powerful. So what we can do here is look at a longer-term opinion in the markets. I'm going to show you an exact example of this, and then we can drill down and be strategic with our entry. And then if we want to, if we get the markets to go our direction, even on a shorter term basis, then we can start to back out and transfer control of our trade to a longer term strategy. And what we've done is we've taken a very little amount of risk and we put ourselves in a break-even situation, worst case scenario, break-even. And if we're right, we can catch a very, very powerful wave and be very, very profitable. Small amount for a large payout. That's a possibility here, or you can just take it and use it for a day trade or a swing trade as well. Now, the key to this whole thing is finding strategic setups as to enter. So that's the key here. And I have found that traders can be fairly good at this. So we can learn this skill here if we're patient and disciplined of finding a lot of powerful setups. And then when we turn over the control, if you will, to a rule-based entry and exit strategy, then this becomes extremely powerful. All right, so let me go ahead to the next slide. Okay, Mark, does volume play a part in your intelligent breakout? I noticed that volume is very important along with price pattern, especially when the breakout is occurring above a base. That is a really good question. I think volume can be a great enhancer of this. So volume can be a great confirmer. You can actually build in volume as a requirement to this. Now, what I'm showing you today does not require volume because some of the examples we'll look at include the Forex market. But in general, and I know there is volume in some cases available in Forex, but as a whole, it's not available. So volume can only make this better, in my opinion. So I certainly would experiment with volume as well. Now, let's go ahead and jump to the actual equation here that I'm using. So in TradeStation, this is a very, very basic code. I'm looking at length 1 for my buy side. This is my parameter of how many bars back I'm going to count. I'm going to use 25 bars as a default. Length 2 is my sell side or my exit. My QTY buy is just my buy quantity, and QTY sell is my sell quantity. So very easy code here using this in TradeStation. Notes, buy means to buy entry, so it's new long position. Sell means to exit the long position. In this particular case, we're looking at a buy-only system. This is not stop and reverse. In fact, there's really no need in this example to have a QTYS. So we wouldn't have a different size. We'd be selling the exact same contract size as we get in with. All right, but very, very simple here. Buy and then exit long. Buy and exit long. Now, here's the sell code. We want to, in TradeStation, same thing. We'll have a length 1 for the buy signal, look back period of how many bars we're looking back. Length 2 would be for the sell side, and then at different quantities as well. And really, that doesn't apply here so much. we're looking to sell short. Next bar, this you can see the logic here. Again, I'm using the -1 point stop. Make sure we actually breach the old low on the short side, and the buy to cover is going to be the look back period for length 1 here, and then it's going to be +1 point stop. So sell short means to initiate a short position, and buy to cover is going to mean to exit my short position in the market. All right, fair enough. So this is very simple code here. If you took this right here and copied it in TradeStation, you would create a working prototype, if you will, of the intelligent breakout, or a very simple breakout. Now it's not intelligent yet. We've got to tweak it here a little bit. So strategic setups. Well, how do we define that? And the best setups typically involve a confluence of 2 or more valid technical analysis patterns or indicator signals. So at valuecharts.com, we look for a confluence of price, momentum, and value. We can have 2 out of the 3, but I find that sometimes the most powerful at least include 2 out of the 3. It could be momentum and price, it could be price and value, or it could be momentum and value. When we have these coming together, it increases the probability that we're going to be able to forecast the next move in the market. All right, so let's go ahead and take a look at some examples here. Now, this example is from I did a webinar in late December talking about the Federal Reserve price action, and I just happened to pull up a chart of the euro currency. And the reason why I'm referencing this is this was you'll see kind of a boxed portion of the chart here. That was the future when I had the webinar. So this large bar here, price bar, it's a daily bar in the euro currency. This occurred on the Friday before I had the workshop. And I said that this was a very bearish setup here for the euro currency. So I'm going to use this as an example of something that I identified, not being smart, but just looking at the different indicators here as a good bearish setup. My reasoning for this was that you'll see that the Friday bar penetrated the previous highs. All right, we got a lower momentum reading with the MQ momentum down here at the very bottom of my screen. You'll see that we have a higher histogram value here, a higher indicator line value here, and then it goes into negative territory with the red histogram bars. And then we have this secondary peak in the momentum indicator. We have 2 green histogram bars and a lower indicator line, lower signal line. So weakening upside momentum, yet we had a higher price that was rejected by the markets. And then not only that, you'll see that our price bar went into significantly overvalued according to the value charts indicator here. So that's the upper red portion here of the price bar. And that we know the market trades at or above that level in the red region here less than 2% of the time historically. So that's fairly significant there. And the market rejected the higher valuation, and the yellow portion right here, yellow and above in the value charts indicator here, we know that including yellow and red represents the upper 16% of valuation trading activity. So there's a whole science behind the value charts here, but value charts are some of the most powerful tools in finding strategic setups that we use. So I was using the value chart here, I was using the price up here, a new high, and then the momentum down here as well. So all 3 of them I was using to identify and broadcast this bearish setup as I had the workshop on that Saturday. So let's fast forward here from there. And what I did after that is drilling down. So we've got a daily setup. So now I'm drilling down to 240-minute charts, and we'll see here that we have a setup within a setup. So this previous run up here on the 240-minute bar was the Friday, okay, before the workshop, and then you can see it sold off in the close. And then the following day here, we see a secondary rally that's weak. It fails to go to new highs. We'll see that the value charts indicator barely goes up into significantly overvalued, and then the momentum to the upside is weakening here as well. Let me see if I can answer any questions here. Let's see, breakouts work on all time frames. Yeah, I think Doyle, the breakouts will work on all time frames, but I would say for what we're talking about today, you want to make sure you drill down. Okay, so what factor is support and resistance in your equation? For support and resistance with a value, or I'm sorry, with the breakout strategy, all we're doing is referencing back to the extreme highs and lows for a certain defined look back period. And I'll show you that here in just a second here. So Let me just make the point here. There's one thing that I'm not showing here, and that is on a weekly basis, the cash euro currency was coming up against a very well-defined downtrend line. So I had my well-defined weekly downtrend line. That's not shown here. I had my daily setup, which was bearish. It was a bearish divergence. And then I also had my setup within the setup. So I've got weakening momentum, and I've got overvalued prices here on the 240, right where I'm pointing here. And this was the future here that we're looking at once we had this setup within the setup. So now the challenge is, okay, let's go ahead and find a way to enter a short position. Okay, let me show you how we can do that. Now, if we apply a breakout strategy that's not where we don't skew the parameters, just a 25 bar on a 60-minute chart, this is what that's going to look like. It can still be somewhat effective. All right, but the problem is we're not giving ourselves the advantage of a strong downward setup. So we had strong bearish setup within a bearish setup. We expect prices to start falling off, and this doesn't take advantage of that to the degree that we want it to. So, but I'm showing you the red line right here represents the lowest low for 25 bars back. The blue line represents the highest high for 25 bars back as well. And this is not what we're looking for. Even though the trade was profitable, let's see if we can do better. This is just a balanced breakout strategy. Now we want to turn it into the intelligent breakout. And the way we're going to do that is tilt the odds in our favor by skewing the breakout parameters to more quickly buy or sell in the expected direction of price movement. This is very important. And the subtleties here of making those parameter adjustments can be extremely powerful. All right, so in this case, for example, on a chart, I'm very bearish right here at my setup within a setup. The market's overvalued. I showed you previously in the 240-minute chart. I can throw up a breakout strategy that's only referencing 1 bar back on the sell side. So you'll see the red line here is much more reactive. It's very quick to follow the price up. As soon as I get a break on that, then I can sell this. All right, and this, you can see that my entry, in fact, let me just go back one slide to show you. My entry before here was right around, call it the 137.60 level. All right, now going forward 2 slides here with the intelligent breakout, I'm actually looking at an entry that's 138.10-ish or so. So instead of risking 50 ticks, because I now have a much more reactive sell parameter here, I'm only referencing the lowest low of 1 bar back, I can now enter much more strategically, much more quickly. Now, a question you're going to have is, well, wait a second, I can get chopped up that way too. The answer is yes, you can. But if you do this correctly, you don't have to risk a lot on those chopped moves. I'm going to show you an example of that as well. So in this case, if I had a 1 bar look back for the sell side, that's the red line, and that red line is just mirroring what my breakout strategy is doing. And then I have a 10 bar or 10-hour buy side, which is the blue line. You can see I'm selling short very quickly here, and then the market slowly starts to taper down and then starts to really sell off. So I'm literally risking 10 ticks here to make what ends up being close to 200. All right, that's the kind of trading we're talking about here. A 50 tick improvement or 50 pip improvement, depending if you're a Forex guy or a futures guy, in my entry, just because I skewed my sell parameter, made it much more reactive. When I say reactive, I'm shortening it. So instead of a 25 bar, I'm looking at a 1 bar or 2 bar. I tend to recommend 2 to 3 bars, but myself, I've used 1 myself a lot too, and that can work very well as well. But the risk of the 1 bar is that it can be chopped up more so than the 2 and 3, but it does get you in quicker. So there's a little bit of a give and take there, and it really depends on the price action for which one I end up selecting myself. Now, the breakout exit here is 10 bars back, so that's a little bit slower. We're not overly concerned about how fast we exit because we know that we're getting in very close to our exit line. Right? So you'll notice on this particular trade, with this these parameters, we can, we had a very nice winning trade here going down for, call it about 200 ticks or so, and then ended up being close to that. Now, one thing you can do here that's interesting, let's say you have an opinion that the market's really going to head south and it's going to start falling off, as my opinion was back then. So I thought there was a good chance the euro currency was going to start to really sell off then. We now know it did sell off for about a month, but it came right back. So in this scenario, I could have done one of two things. I could have taken my profits or part of my profits when it did sell off, or I could simply put a break-even stop in place at my entry level and then transfer the control of the trade to a longer term time frame, and eventually even go all the way out to daily or even weekly. So we have a lot of attractive options here that we can take a look at. So in this case, again, the transfer and control aspect of this is great. I only risk 10 ticks to get in, and once I have a degree of separation, the euro sold off about 200 ticks below, I can now transfer the control to a longer term strategy to try to ride a longer term wave. And this is an example, again, where it didn't do what I wanted to do longer term, but that's okay, because sometimes you have to try 2 or 3 times to catch that longer term wave. The euro now looks like it may be starting to head south, but we'll see. This is a chart of the just the futures here, and you can see that this wasn't quite as close to the downtrend line as the cash was, but the cash was essentially almost touching this downtrend line, and that's why I had a bearish outlook from the weekly basis, the monthly basis, and also from the daily and 240. So I had a lot of nice bearish setups there that caused me to broadcast that the bearish setup to our clients. So yeah, you're right. In this Joe, you're right. In this case, I was stopped out at break even, no problem. Live to trade another day. But if you catch the wave just right, our best scenario there even was being profitable upwards of 200 ticks there. I was looking for a longer term move, but this can be very effective if you just want to take your profits and run. What is your criteria for transfer control to a longer term time frame? Seth, that's something you want to just experiment with, but my recommendation would be to be up. You want to have a degree of separation of, in my opinion, it's a larger point or two. So it would be a couple hundred pips or a couple hundred ticks in the currencies and the bonds. It could be a point in the S&P 500. It might be 10 index points. So it really depends on what you're trying to do. If you're trying to go for an ultra long-term trade, then you could, you may want to wait for a reasonable degree of separation, okay, to put your break-even stop in. And again, that's a little bit more art than science, but what, for me at least, if I'm looking for a longer-term play like I was in the euro currency, I would be looking at 200, maybe 200 or 300 ticks away or 2 or 3 points away before I'm looking to do that. And in this case, you have to remember that my actual stop level that I originally placed was only about 10 ticks above my entry level. So I'm hardly risking anything on the trade to begin with. So it's not like there's a huge difference between those two, but if I am in the money by a good bit, I'm usually looking to move my stop down to break even. But the risk there, and what you have to be careful, is if you move it down too quickly without getting an adequate degree of separation, then you run the risk of the market jabbing right back up and stopping you out. So a little bit of an art there. I just challenge you to study that a little bit, and then you'll get a gut feel for when that's appropriate. Almost impossible to see the lines or prices on these black charts. Yeah, Chris. Well, there's the whites and blacks. I'm showing the black because I'm showing the value chart setup, which contrasts with the yellow and the black better than white. The yellow doesn't contrast with white, so that's the reason behind that. Now this another example where I broadcasted a sell signal on the stock market. We had a yellow hat doji here. It was also against some resistance at this level as well. And so this was broadcast to our members at valuecharts.com. I'm going to show you just an example here of a common type of setup we use, value candles. And we had weakening momentum with the histogram. We had the cycle finder also looking like it's topping out with a red histogram bar down here at the bottom. And then not shown is the fact that the S&P was right up against resistance. So let me show you how I trade this. This is me being fairly aggressive here with some entries. Now, I was looking at you'll see some sell signals here. I was looking at something that was along the lines of a 100 tick bar, all right? And then I went out to 200 tick bars and I used 2 bars back, okay? And that's what the setting was here. And so that's, initially I was a little bit too aggressive here with my entries, got stopped out a little bit, and then I eventually caught the wave I was looking for with this sell-off to take advantage of that. So, and you can see here, once I caught the wave, I had a really nice down move through the close and into the next day and was able to take some nice profits and end up making more than enough to cover my losses there. So this is what it could look like in real life, okay, depending on whether you use a 1 bar break or 2 bar break. But in this particular case, I wanted to point this out the benefits of making sure that your time frame or your tick bars are not too reactive. You don't want to get chopped up too much, but also making the point that right here, if I had just used a 2-bar look-back period, I would have had no false trades here, because the 2-bar look-back period, depending on when I applied it, so right here, actually the first one, I take it back, I would have had a stop out with this first one, but the second trade and the third trade here, they would have been avoided. All right, so and then eventually when I get in here with the actual trade, caught it, the move, and actually went down a number of points and ended up being a very profitable trade. Let's take a look at this. So I'm using a 50 and 2, so I have very long-term exit, very reactive entry there on my inputs, and then you can see how this looked longer term. So this is where I end up. So a few chops there did not hurt me too bad, and I was able to catch this real trade here and able to take a nice little profit out of the market here over time. And then you can see my 2-bar red entry graphic here, my indicator line. It really moves down, hugs prices because it's very reactive. And then the blue line is much slower to move down. Blue line is my exit criteria. I just got out before or by the close. So that's just something I did. I could have waited though for the exit line to actually trigger and I think make it even a little bit more money than I did. But this just gives you an idea of how you can use this to day trade and how this can be very powerful, especially in the context of a longer term trade. So you can use the time charts for your setups, which are very effective oftentimes, as well as some tick bars as well. And then I like to drill down to tick bars for my entries quite often because they tend to be fairly effective. Okay, I didn't understand the time frame you were using. So yeah, the time frame for the setup was a 60-minute. And again, I did that on the S&P, but all the stock indices are correlated. So I will choose the weakest sister, if you will, a lot of times when I'm dealing with the stock indices. But I like the setup on the S&P, and I looked at the Russell 2000 and projected that to be very weak as well. And then I just started to trade, in the Russell with the intelligent breakout strategy, making my entry very reactive using 250 tick chart here. So 250 tick bars. And then this is based on ticks, not volume. And then I'm looking to make my entry 2 bars back on the downside. That's my red line. And my exit was 50 bars back. So that's a blue line that's really slow here to follow price down. Okay, and that might have even modified that blue line. So, all right. So let me just throw this out here. That was TradeStation, by the way. If you have not looked at the value charts indicator, what we've done here is this has been historically available in our large bundle at $1,000. Okay, a lot of traders came up to me and said, Mark, I want to kick the tires and try this indicator before I commit investment. We totally understand that. So what we've done here is we've taken that out, the value charts indicator, which is very powerful for finding great setups that you can use alongside the intelligent breakout strategy, and we're selling that by itself for $97, limited offer. And for the first 25 people who are interested in this, call or just go to valuecharts.com/value. All right, and you'll see that. You will not be able to find this on our website. It's not available on our website at valuecharts.com. You have to go to the short link here. Give us a call here in customer service, 919-935-0010 if you have questions. If somebody does not answer, we will get back to you because we have quite a few people calling, it looks like. Okay, why ticks and not volume? You can use volume. You can use volume as well. So that would be valid, and it's just personal preference. Okay, I don't understand time frame. Okay, let's see. All right, so this is basically the intelligent breakout strategy is very powerful, and it's something I'd encourage you to try, at least if nothing else. Try simulated trading with it, and you can even try following some of the setups that other people broadcast as well. Like for example, valuecharts.com, we have 2 live trading rooms every day, one for stocks and options, one for futures and forex. And our guys are actually using our tools to show you setups in real time. So our goal is education, teaching our members how to find setups using our tools, value charts and momentum and price. And then at the same time, if you have a preferred educator that you use, with candlesticks or another methodology, then I would challenge you to use the intelligent breakout strategy with that and try it out. It's very simple, very easy to use, and it can be very powerful as well. So that's what I would say. The $97 deal is available for, I believe, until the end of this week. So visit again valuecharts.com/value. Again, give us a call if you have any questions on that, but do not go to our website because you will not find that. Don't go to the website, just valuecharts.com. That is not available. You have to go /value to find this limited time offer, $97 for the value charts indicator by itself. And again, if you haven't traded with this, check it out. It's very powerful. This is an indicator that we found was very powerful on the hedge fund side as well. I essentially worked to design this because I thought there was a major gap or hole in the objective value indicators in the markets. And we actually have a patent on this right now. So we're the only ones in the world that offer this indicator. And $97 is the cheapest you're ever going to find it. So otherwise, normally you just have to buy it inside of our core bundle, and that's for $9.97. How does it work? Yeah, it does work in NinjaTrader. It works great on NinjaTrader. So in fact, it has color bands instead of the colored bars. And I think the colored bands is a very nice look inside of Ninja. So check it out. But yeah, NinjaTrader is a great platform. It does work very, very well on NinjaTrader as well. And it has toss, think, or swim. We also have multi-charts, e-signal as well, and we also have Sierra charts. If you have another platform out there that I didn't name or that we don't have available on our site, just let us know, and we can, if we get enough requests, we'll try to develop it for that as well. Scottrade Elite, do you know if they allow third-party people to develop indicators for Scottrade? I wasn't aware that they did, but let me know. Toss, yes, looks good in Toss. I like it in Toss. Works on TradeStation. Yeah, what you just saw was TradeStation. Do you need a special feed for the value charts indicator? So what you want to do for the value charts indicator is we've developed it for different platforms out there. So we're not offering the value charts as a standalone software package. It's an indicator that you have to install on one of a number of different platforms out there, again, including TradeStation, NinjaTrader, Thinkorswim, Toss, multi-charts, Sierra charts, and eSignal. So those are all the ones we've actually developed this for. Schwab, Street Smart Edge, do you know if they allow third-party developers? Because a lot of the larger brokerage firms have not historically. They might have changed, but I'm not aware of that. We certainly would do that. FXCM, we are looking at doing value charts for MT4, so stay tuned if you use that. FXCM, I would say hold on for the platform that we're working on developing right now, and we've just been a little bit late to the market with. It's going to be functional, we expect, on Forex and FXCM as well. Yeah, for Charles Schwab, I don't think that they actually allow third-party developers to develop on their platforms. So anyway, so this is just getting back to the whole point of this is that value charts are extremely powerful. Again, it's a skill you're going to have to develop, but very powerful to find those very strategic entry points. But on top of that, regardless of what you use for your setups, I would challenge you to check out the Intelligent Breakout strategy. It's a great way to trade. You don't want to leave it on all the time. You just want to flip it on when you find your setups you like and just track it. Do some sim trading and see how it works out for you. And compare that, even against the way you enter and exit markets yourself. So a lot of traders can, they just find that they want some guidance there on when to exit and when to enter markets and where to place your stop loss. And the Intelligent Breakout can be extremely powerful for that. Okay, let's see here. Can one adjust parameters? Yeah, absolutely. On NinjaTrader and Toss, you want to adjust parameters. So you have the choice in value charts to be very short term. If you want 5 bars back as the shortest term valuation analysis we recommend, and the longest we recommend is 50 bars back. So you can look at kind of a shorter term or longer term valuation perspective of the market, and keep in mind that each time frame has a unique valuation with objective value. So long-term real estate investors will think in terms of objective value very differently than short-term. And value charts, by the way, it deals with the psychology of active participants in the market relating to how they perceive fair value, overvalued, and undervalued price levels. So there's a huge psychology element in there. It's very powerful. It's been validated by PhDs in terms of its effectiveness to define valuation. It does not mean, let me just say this, it does not mean that you want to sell if the market's overvalued or buy if the market's undervalued, okay? Because it could be a value migration or a value reversion. There's those two options out there. But you'll start to identify and get a feel for which one of those has a higher probability of happening over time, which is usually the reversion. And then when you combine it with other indicators like momentum or support and resistance, geometric chart patterns, or candles. We use value candlesticks, very powerful. It becomes a very, very powerful tool. Value charts they're easy to read, John, but they do require that you spend some time to develop skill, like anything else. The more you work with it, the more you develop it, the more powerful it gets. All right. Let's see, is the code transferable? Yeah, if you buy the code, John, on one platform, we'll let you apply it to several. No, we're here to help. See, value charts easy to read. Yes. Does it work on Renko or range bars? Now, it's a very good question. It actually, you can apply it to Renko and range bars, but it's not really designed to work on those. And I'll tell you why. Value charts have a specialized unit in the indicator. And again, by the way, just before I go back and show you this, valuecharts.com/value is where you want to go to get the value charts indicator and to take advantage of the special. Charts use a specialized unit called dynamic volatility units. And so those are volatility adjusted, and so we rely on our charts, either tick or time bars, to give us a volatility component of the market. So they're not really designed to be effective on a range or Renko, right? But you can use it in conjunction with that. So I'd apply the value charts to either time bars, tick bars, or tick volume bars in general. Breakout code you posted earlier. Yes, let's see. Yeah, the code, all the code you see earlier is very easy to put on other platforms. John, if you want a copy of that code, just ping us at support@valuecharts.com or watch the video here, and you can have a programmer or developer build you out an indicator or a strategy if your platform allows on a different strategy or platform other than TradeStation. Okay, well, I don't want to run over here. Morgan and Yana, a great group of folks here today. I thank you for your time, and yeah, if you have any questions at all, we're available. Again, call our number or come visit us at valuecharts.com. We're going to show you a very powerful way to approach trading the markets. And again, try the Intelligent Breakout. It's a great way to trade the markets. Thank you, Valerie. And thanks, folks, for taking time today to listen.